If you've ever looked into investing, you've seen it everywhere, right? The PE ratio. It's the go-to metric, the first thing everyone learns when they're trying to value a stock. But what if I told you that this incredibly popular number is basically lying to you? Yeah, let's get into it. So that really is the big question we're tackling today, isn't it? Can we actually trust the price-to-earnings ratio to tell us if a company is cheap or if it's expensive? I mean, it's popular for a reason. It's super simple to find and understand. But here's the catch. That very simplicity, that's its biggest problem. And this is the absolute core of it. The PE ratio is blind to two huge things, a company's debt and its cash. It completely ignores the balance sheet. So you have no idea if a company is secretly drowning in debt or if it's sitting on a massive pile of cash. And trust me, that little detail, it changes everything.
Okay, so to really wrap our heads around this, let's think about the PE ratio as just a simple price tag. You know, like the sticker price you'd see on a car. It gives you a number, sure, but it almost never tells you the whole story of what you're really going to pay.
All right, so just a quick refresher, what is this thing? Well, the price-to-earnings ratio is just the company stock price divided by its earnings per share. That's it. And it's popular because it seems to answer a really simple, important question. How much am I paying for every dollar of profit? Sounds good, right? But the problem is, that's not quite the right question to be asking.
Okay, the best way to see this in action is with a little thought experiment. This is where the lights really come on and you see just how misleading the PE can be. Let's imagine we have two companies. We'll just call them Company A and Company B. So take a look at this. On the surface, these two are twins. Both have a price of $1,000, both have earnings of $100. You do the math and boom, they both have the exact same PE ratio of 10. You'd think they're the same deal, but then you look at the balance sheet and whoa, Company A is sitting on $500 in cash. Company B? It's saddled with $500 in debt. Suddenly, they don't look so identical anymore, do they?
And that's the whole point, right? The stock market's price tag, the market cap, is exactly the same for both of them, $1,000. If you only look at the PE ratio, you just shrug your shoulders. You might as well flip a coin.
But let me ask you, which one would you rather own? The one with $500 of cash just sitting in the bank, or the one that comes with a $500 IOU that you're now responsible for? It's a no-brainer, right? You take Company A every single time. That cash effectively makes your purchase price cheaper, and that debt makes Company B way more expensive. Company A is the real bargain here, and the PE ratio was completely blind to it.
So, okay, the PE is broken. How do we fix it? Well, we need a total mindset shift. We have to stop thinking like we're just buying a little piece of paper, a stock, and start thinking like we're buying the entire company. We need to put on our acquirer hat. And when you start thinking that way, it leads you to a much, much better metric. It's called enterprise value, or EV for short. Think of this as the real takeover price. It's the price you'd pay to own the whole shebang, lock, stock, and barrel. This is the tool that pros use to figure out what a business truly costs. So how do you figure it out? It's actually pretty intuitive. You start with the market cap. That's our sticker price. Then you have to add the company's debt, because if you buy the company, you inherit that debt. It's your problem now. But here's the cool part. You get to subtract the cash on its books, because once you own it, that cash is yours. What you're left with, that's the enterprise value. That's the real all-in cost. Okay, so we've fixed the price part of price to earnings. We've got our enterprise value. Now we just need to fix the earnings part of the equation to build a truly powerful metric.
And to do that, we're going to swap out net earnings for something called EBIT. It stands for earnings before interest and taxes. Now, why do we do that? Simple. It just gives you a much cleaner look at how profitable the actual business operations are. It strips out all the noise from different tax rates or weird financing decisions a company might make.
And now, we put it all together. You take the real price, enterprise value, and divide it by that cleaner measure of profit, EBIT. This new ratio, EV to EBIT, is just miles better. It gives you the true yield of a business. It finally answers the right question. For the total, all-in price I'm paying, how much actual operating profit is this business kicking out every year? And listen, this isn't just some academic theory. The legendary investor Joel Greenblatt literally built his famous magic formula strategy around this very concept. His first step? Find companies with a high earnings yield, which is just a fancy way of saying a low EV to EBIT ratio. In other words, find a cheap business. His second step was to find good businesses, ones with a high return on capital. It's an incredibly powerful combination. Buy a good business at a cheap price.
So you see, this is so much more than just learning a new formula. It's really about a fundamental shift in philosophy. It's a whole new way to think about what a business is actually worth.
I think this quote just nails it. You have to stop looking at the price tag. You have to start looking at the total cost of ownership. The PE ratio, that's the shiny sticker price in the window. The EV/EBIT ratio, that's the real drive-off-the-lot price, after you've considered everything. It forces you to look under the hood.
And that kind of leads us with one last question to chew on, doesn't it? This whole idea of looking past the obvious price tag, it doesn't just apply to investing. I mean, think about it. Where else in your life might you be getting fooled by a simple price tag, completely missing the bigger picture of the true total cost? It's a pretty powerful idea to take with you.